If you checked your investments today and thought, all right, the market is just having a bad day, I need you to pause for a second. Because this isn't just a bad day, and it didn't start in the United States. The real problem is happening on the other side of the world, in Japan. Here's why that matters to you. Japan isn't just another country with its own stock market. Japan has been one of the biggest reasons money stayed cheap for so long. And when that changes, when Japan's money system starts cracking, it doesn't stay over there. It spreads. It pushes and pulls on currencies. It forces big investors to sell. It hits U.S. bonds. And when U.S. bonds move, everything else moves with them. Mortgages, loans, stocks, even the money sitting in retirement accounts. Most people won't connect these dots until the damage is already done. They'll just see their portfolio dropping and wonder why it feels like the market is broken. So in the next 15 minutes, I'm going to explain this in plain English. What Japan just triggered, how it jumps from Tokyo to the US, and what you should watch so you're not blindsided when the shockwave arrives. Because this isn't a small story. This is the kind of story that shows up later as a very real problem in your everyday life. For the last few decades, Japan has played a role most people never talk about. Not in politics, not in headlines, in money. Japan kept interest rates extremely low for a very long time, close to zero. That sounds boring, but it created something powerful, cheap money that could be borrowed again and again. Here's the simple version. If you can borrow money at almost no cost, you can take that money and buy other things that go up faster, like U.S. stocks, real estate, and even crypto. And when millions of investors and big institutions do this at the same time, it becomes like pouring gasoline on a fire. That's why markets felt unstoppable for so long. Not because everything was healthy, but because so much cheap money was constantly flowing in. Japan became the quiet money source for the world. It didn't look dramatic, but it kept the whole system running. It helped push asset prices higher and higher. Stocks, houses, tech companies, everything. So Japan was never a small side story. Japan was one of the main engines behind the easy money era. And if that engine starts to break, the effects don't stay in Japan. They hit everything that was boosted by that cheap money in the first place. Now here's the moment everything changes. Japan has a huge bond market, basically the place where the government borrows money. And for years, that market was controlled. Rates stayed low, yields stayed calm, and investors believed Japan could keep it that way forever. But that belief is breaking. And once yields start rising, the whole game changes. Because in the bond world, small moves are not small. A little jump in yields can cause huge losses for anyone holding those bonds. It also makes borrowing more expensive across the entire system. This is why people say, when yields move, the math changes. It's like a building where the support beams suddenly shift. You don't need the whole building to collapse immediately. You just need the structure to become unstable. And once it's unstable, everyone starts running for the exit at the same time. That's why this isn't just a normal market dip. This is forced selling. This is big players selling because they have to, because the rules that kept things stable just snapped. And when that happens, markets don't act calm and logical. They act like a crowd in a fire. The smart money isn't asking, is this asset still good? They're asking, can I get out before the door jams? And once the door starts jamming, everyone smells danger. Everyone gets aggressive. Everyone turns defensive. That's when the real panic begins. Now we get to the engine inside the engine, the part that explains why Japan can punch the U.S. market in the face without firing a single shot. For years, there was a simple money trick investors used. Borrow Japanese yen cheaply, then use that money to buy higher return assets somewhere else, especially in the U.S. That's the carry trade. In plain language, Japan's cheap money became a credit card for the rest of the world.
Big funds, banks, and traders borrowed yen at almost zero cost, then put that money into U.S. stocks, U.S. tech, real estate, and even crypto. And when millions of investors and big institutions do this at the same time, it becomes like pouring gasoline on a fire. That's why markets felt unstoppable for so long, not because everything was healthy, but because so much cheap money was constantly flowing in. Japan became the quiet money source for the world. It didn't look dramatic, but it kept the whole system running. It helped push asset prices higher and higher, stocks, houses, tech companies, everything. So Japan was never a small side story. Japan was one of the main engines behind the easy money era. And if that engine starts to break, the effects don't stay in Japan. They hit everything that was boosted by that cheap money in the first place. Now here's where this stops being a Japan problem and becomes an America problem. Because Japan doesn't just borrow money. Japan also owns a huge amount of U.S. government debt, U.S. treasuries.
Think of treasuries like the foundation under the entire U.S. financial system. When treasury rates move, everything moves. Mortgage rates, car loans, business loans, credit cards, the stock market, all of it. For a long time, Japan was one of the biggest steady buyers of these treasuries. Quiet, consistent, reliable. That mattered more than people realize, because when a giant buyer is always there, rates stay calmer, borrowing stays cheaper, the system stays stable. But in a crisis, that giant buyer can turn into a giant seller, and that's the nightmare. If Japan needs cash to defend its currency or needs to bring money back home, it can sell treasuries to get dollars fast. And once that starts, one question becomes the entire story. If Japan is selling, who's buying? Because treasuries aren't like a meme stock. The market is massive. It needs huge buyers every single day. If the biggest buyers step back, yields jump. And when yields jump, the cost of money rises everywhere. This is how you get a situation where rates spike even when it feels like nothing happened in the news. The bond market is reacting to the disappearance of a buyer. And when there aren't enough buyers at the price the sellers want, you get what traders fear the most: a market with no real bid, a bidless vacuum, a liquidity event. That means the market isn't moving because people are making smart choices. It's moving because the system is losing balance. And once the treasury market loses balance, it doesn't stay contained. It spills into everything. Now let's talk about the first domino that gets hit the hardest: tech. And not because the companies suddenly became bad businesses, because tech is liquid. Tech is easy to sell. Tech is where the big profits are sitting. When a fund needs cash immediately, they don't sell the stuff that's already down 60% and impossible to move. They sell what they can sell. They sell the winners. That's why the biggest U.S. tech stocks, what people call the Magnificent Seven, are so important in this story. For years, these companies acted like a sponge. All that cheap money from around the world flowed into them. It pushed them higher and higher, and it made them feel untouchable. But now that the money flow is reversing, those same stocks become the world's ATM. Not because investors suddenly hate Apple or Microsoft, because someone needs cash today. This is why markets can start acting crazy. A company can report great earnings and the stock still drops, not because the company is failing, but because somewhere else a big investor is being forced to raise cash to cover a loan. And they raise cash by selling the most liquid assets they own, usually big U.S. tech. So you get this strange reality where good news becomes bad news. Everything becomes backwards. And then it gets worse, because humans aren't the only ones trading. Algorithms are. And algorithms don't panic emotionally. They panic mechanically. They're designed to reduce risk fast. And the fastest way to reduce risk is to sell what's easiest to sell. That's why the winners get hit first. It becomes a chain reaction. Carry trade, unwind,
margin calls, forced selling, tech used as ATM, index drops, more risk models trigger, more selling. So when you see tech sliding hard, don't assume it's just a normal rotation. Sometimes it's the sound of a liquidity problem starting to spread. Now domino number 2, and this one is where things stop being market drama and start becoming real economy pain. U.S. banks. Here's the simple issue. Banks own a lot of bonds, including long-term treasuries and other long-term debt. They bought many of these when rates were low, because back then, bonds looked safe. But bonds have a brutal rule. When rates go up, bond prices go down. So if Japan's selling pressure pushes U.S. yields higher, those bond portfolios inside the banking system lose value. Even if the bank doesn't sell the bonds, the losses are still real in a practical sense, because the bank's balance sheet gets weaker, the cushion gets thinner, the risk gets higher. And once banks feel weaker, they start protecting themselves the fastest way they can. They stop lending. They tighten credit. They make it harder to get a loan, harder to refinance, harder to get approved. And that's how this turns into a doom loop. Because when credit gets tighter, businesses struggle to expand or even survive. Consumers pull back. The economy slows. And then loan defaults start rising. And rising defaults hit the banks again. So banks pull back even more.
That's the loop. Yields rise, bond values fall, banks weaken, lending dries up, economy slows, defaults rise, banks weaken again. This is why bond stress is never just a bond story. When the bond market gets unstable, it eventually shows up as layoffs, bankruptcies, and shrinking opportunity. It's the invisible part of the system becoming visible. Now domino number 3, real estate. And this is where people get shocked because they assume housing depends on whatever the Federal Reserve says. But mortgage rates don't really follow the Fed's speeches. Mortgage rates follow the 10-year treasury. And the 10-year treasury is exactly what gets hit when big players dump U.S. bonds. So if Japan's crisis pushes treasury yields higher, mortgage rates can jump fast, even if the Fed doesn't do anything new. That's the punchline. Japan sneezes and your mortgage rate catches a fever. And when mortgage rates spike, the housing market doesn't just cool down, it freezes. Because buyers can't afford the payment, sellers don't want to give up their low rate, transactions slow, inventory gets weird, prices get unstable, and entire industries connected to housing start feeling it. Agents, builders, lenders, contractors. But residential housing is only half the problem. The scarier half is commercial real estate. Office buildings, shopping centers, apartment towers with huge loans. A lot of that debt has to be refinanced soon, and those loans were built on the assumption that rates would stay low forever. Now picture what happens when those loans come due and the new rate is double what it used to be. The math stops working. Owners look at the numbers and say, "Why would I keep feeding this thing?" So they walk away. Not because they're emotional, because it's cheaper to default than to refinance. That's why you get what people call strategic defaults. And when that happens, here's the ugly one-liner that explains the whole chain. Landlords hand the keys back, and the banks inherit the crater. That's how bond stress becomes real estate stress, and real estate stress becomes banking stress, and then it starts to spread everywhere else. Now, domino number 4 is the one most people never see coming, because it sits outside the normal banking system. It's the shadow system. Private credit funds, non-bank lenders, highly leveraged hedge funds, big pools of money that act like banks but aren't treated like banks. These groups have become huge over the past decade, and they grew in the same way everything else grew. Cheap money. Borrow cheap, lend expensive, collect the difference, repeat. But when rates rise and liquidity dries up, that model breaks fast. And here's the scary part. When a normal bank gets in trouble, there are safety nets.
There are emergency programs. There's FDIC protection for depositors. But in this shadow system, no FDIC, no backstop, no "we've got it under control" press conference that actually protects you. If one of these big funds blows up, the losses don't disappear. They land somewhere. And a lot of the time, the somewhere isn't a billionaire speculator. It's pension funds, it's retirement funds, it's endowments, it's regular people who never even knew their money was connected to these risk machines. This is why people bring up Silicon Valley Bank as a warning. SVB showed what happens when rates move too fast and balance sheets can't handle it. But SVB was a single institution. What we're talking about now is the same type of stress spreading through the global system. It's a bigger version of the same movie. And when the shadow system cracks, it doesn't crack politely. It cracks suddenly, violently, and without a clear rescue plan. Now, here's where it gets truly dangerous, because once this starts, the people in charge don't have a clean solution. They have two options, and both hurt. Think of it like two doors. Door number one, cut rates and add liquidity. That can calm markets, it can slow the panic, it can give the system breathing room. But the cost is huge. Inflation comes back, the dollar loses power, and everyday prices rise again. In simple terms, they save the system by making your money worth less. Door number two, keep rates high and stay tough. That might protect the dollar in the short term, but it makes Japan's situation worse faster. It keeps pressure on bonds, pressure on banks, pressure on debt, and it increases the chances of something breaking in the global system. So they're trapped. If they try to protect the currency, they risk collapsing parts of the system. If they try to protect the system, they risk destroying the currency. And this is why it's so tense between countries right now. Because the US and Japan are allies, but when survival is on the line, every country protects itself first. That's the ugly truth. It becomes a prisoner's dilemma between allies who are both drowning in debt. And when debt is that high, good choices disappear. Only bad choices remain. So what do you do with all of this? You watch the warning signs like a seismograph, because big financial crashes don't arrive out of nowhere. They send tremors first. Here are the key signals to track. Number one, the 10-year U.S. Treasury yield. This is the backbone rate. If it starts climbing fast, it means stress is spreading through the bond market. And when the backbone rate moves, it pushes up mortgages, business loans, and pressure across the economy. Number two, USD/JPY, the dollar versus the yen. This one sounds technical, but it's simple. If the yen strengthens quickly, it often means the carry trade is unwinding faster. And when that unwind speeds up, forced selling usually speeds up with it.
Number three, credit spreads. That's just a fancy way of saying how much extra interest do risky borrowers have to pay. If those spreads start jumping, it means fear is rising and the market is starting to price in defaults. Number four, the VIX. This is the market's fear gauge. When it wakes up after a quiet period, it usually means the calm is ending and volatility is coming back in a serious way. And if you want one extra inside baseball signal, watch liquidity itself. When bond markets start moving with big gaps and weird swings, it can mean buyers are disappearing. And when buyers disappear, the next move can be violent. These indicators won't predict the future perfectly, but they will tell you when the ground is starting to shake before the main event hits. Now let's talk about protection, because in a situation like this, you don't need perfect predictions. You need a plan that survives chaos. When markets are being forced to sell, the first rule is simple. Liquidity matters more than opinions. In the short term, during a true liquidation event, cash becomes powerful, not because it's exciting, but because it gives you control. When everyone else is stuck selling, cash lets you wait, stay calm, and move when the panic creates real opportunities. That's why people say in a liquidation, cash is king. But here's the twist.
cash is great during the crash and risky during the rescue, because the rescue usually comes with money printing, rate cuts, and currency weakness. That's why the longer-term lifeboat usually points to hard assets, things that can't be created out of thin air. And the most classic hard asset in that category is gold. Gold isn't perfect. It doesn't pay interest, it doesn't produce cash flow, but it has one advantage that matters in a currency mess. It isn't someone else's promise. It doesn't rely on a government staying disciplined. It doesn't depend on a central bank doing the right thing. It just sits there, outside the system. Another place people hide in times like this is short-term treasury bills, not long-term bonds. The idea is simple. You get safety and liquidity without taking the big price risk that comes with long-duration bonds when yields are rising. And if you're looking at stocks, the focus usually shifts away from hype and toward survival. That's where defensive areas come in, things people keep paying for even in hard times. Utilities, healthcare, consumer staples, the stuff people need, not the stuff people want. And here's what tends to get hurt the most in this environment: high-risk, high-volatility stocks, unprofitable growth companies, small caps living on cheap debt, businesses that only survived because borrowing was easy. Those are the zombie companies of this cycle. They look alive until the credit gets expensive. That's why broad small-cap exposure, especially the parts packed with weak balance sheets, can become dangerous when the easy money era ends. So the big picture is a barbell approach. On one side, you want liquidity and safety. On the other side, you want real things with real demand. Because in a shock like this, the middle ground, the over-leveraged, overhyped part of the market, is usually where the damage concentrates. And now we zoom out. Because this isn't only a market story, it's a power story. When a country like Japan starts wobbling financially, the effects don't stop at rates and charts. The entire region starts to shift, alliances get stressed, trade routes change, and a vacuum forms. And whenever a vacuum forms in global power, someone moves in to fill it. That's what makes this so much bigger than one bond market. Because if Japan gets weaker, Asia rebalances. Countries that depended on stable Japanese money and stable Japanese funding start looking for a new anchor. And in that kind of moment, influence can change hands faster than people expect. Now, there's another layer here that people are whispering about, what you could call a currency war scenario. Not as a guaranteed event, not as a conspiracy headline, as a mechanism that becomes tempting when the pressure gets unbearable. If the yen is under extreme stress, one possible way to relieve it is a weaker US dollar, and the easiest way to weaken the dollar is more money printing or looser policy. But if that happens, understand what it really means. It doesn't solve the problem, it moves the cost onto you. You feel it at the gas pump, you feel it at the grocery store, you feel it in rent, utilities, and everyday bills. That's how these crises work. They don't vanish, they get paid for somewhere. And here's the final point that people keep trying to ignore. This debt bomb isn't a metaphor. It's compound interest. It's decades of borrowing stacked on top of decades of promises. And once the bond market stops believing in the story, gravity takes over. Bond math is gravity. It doesn't care about excuses, politics, or confidence. The shock wave is already in motion. The pipes are already shaking. America has already tested positive for the contagion because our system is tied to the same global leverage that Japan helped create. So the question is not, can this hit the US? The question is, how fast and how hard? Brace for impact. And in the next part, we're going to get practical. We'll break down the hidden pressure points inside U.S. institutions, and I'll give you a clear step-by-step checklist to reduce risk and Japan-proof your finances before this gets worse.